some of the stuff that's kind of resonated with what Joanna is saying has been with investors in ETFs who are trying to figure out ways to enhance that yield. Have you seen any signs of stress in your mind with regard to maybe possibilities for concern down the line because of deteriorating credit quality? Is the economy flashing some signs that maybe things are slowing down a little bit? How exactly does the macro picture shape up, given what we are seeing in terms of a tilt towards income strategies? And do those income strategies then have to be a little bit more closely scrutinized because of some of the macro factors at play right now?
Yeah, I don't necessarily see stress. I mean, credit spreads are still on multi-decade lows, whether it's high yield or investment grade. Financial stocks, specifically the banks and some of the capital market names, still are okay, right? If you look at big bank ETFs, that's a pretty good barometer of how the market might reflect the economy. I think the one stress point that stands out are private capital stocks, right? The public PE and private credit type names seem to be having some trouble. And there are headlines that are out there of private credit funds being marked down recently, which is where I think the ETF, like PCMM that Joanna has, comes in handy, where it's transparent. You can figure out what the holdings and the ingredients are in this thing. They're all properly rated. And so I think if you're going to see any further stress, maybe it shows up there. But so far, that's okay. It looks a little bit more, I don't want to use the word contained, but that seems to be the stress point right now, is these private capital type names and the less liquid vehicles that are out there, as opposed to, say, in the ETF space. If you wanted to see in the derivatives what's going on there, I would kind of pay attention to what some of these metal names are going on. How long do they trade at a premium or discount for going forward? Because that's where the action is. But that's completely unrelated to what's going on here, for what that's worth.
Sure, Joanna, I mean, the private credit side of things has been focused on for a couple years now, but it's been around for a long time before that. It's only recently, in the last few years, that it's come to the forefront because people have been able to invest in it through fund formats or through ETFs. Is there, in your mind, a education or knowledge gap with regards to people who are investing in traditional bond funds, whether they be on the rate side of things or investment grade corporate, and then kind of making that move to reach for a little bit more yield in private credit? Are there things that you feel as though maybe aren't being appreciated about what you need to understand about private credit investing that some investors don't know, and all they see is the higher yield that they might get?
Yeah, I think the yield is attractive, and that's a good reason to look at private credit. The reality is that more companies are private than they used to be. So 20 years ago, even 25 years ago, there were maybe 8,000 publicly listed companies. Now that's down to 4,000. It just means that the full opportunity set isn't available to you unless you look over the fence into private equity and to private credit of all of the American companies that you're able to invest in. So that's an important thing. That's why you should look. The yields are very attractive. But one thing that I think people need to understand about the structures in something like PCMM is, that it's a very well diversified exposure to private credit. So it holds CLOs that are bonds that underline loans, of direct loans to companies. But what's in there is there's also multiple managers. So what you're seeing in the press is you're seeing maybe a fund of one manager and one manager's assets being marked down, and that's going to happen. There may be a concentration in that manager's approach or in the loans in the companies that are in their fund. In something like PCMM, because of the way it's structured, you're getting exposure to almost over 7,000 of those loans. And there's 27 different managers in that portfolio. So the immense diversification, it seems to be the right approach in an ETF. It gives you a pure play to private credit, because 80% of the exposure in that product is private credit. And I think there's been a lot of discussion about other vehicles and ETFs that may not be 100% private credit. So if you're really looking to get the full opportunity set, reach for those yields with the risk characteristics I described, I think that it's important to start engaging with private credit and not be so trepidatious about what you're seeing in the headlines, because you should be looking for something that gives you access to the whole broader exposure.
And Todd, before we let you go, the one thing that could derail what's happening in the markets right now, in your mind, in the next couple of quarters, what would you be watching out for?
A credit event. If any of this private credit in the illiquid space starts to leak into other areas of the financial system, I don't have any edge on that, but that would be my, kind of the glaring sign of risk. I think that's out there. Quite frankly, everything else so far seems all right. Right? Credit spreads are still okay. Banks are still okay. The consumer seems all right. But I think it would be some sort of credit event out of left field that leaks into other areas that we're not maybe focused on.
And Joanna, same question to you. What exactly would you be keying in on from a data perspective, a macro perspective, or anything else with regard to whether or not something does maybe happen badly down the line?
I think we have our eye on credit events. I think we also think about, as I mentioned, the diversification. It's hard to say. We had a huge credit event with a bank failure 2 or 3 years ago, and this economy absorbed that. So I don't know that a credit event would be on our top list. I think we want people to be paying attention to the risk in their portfolio and adding as much income as possible. I think on the side that we've seen investors take probably too precariously time and time again is going too far out on the curve into the 20-year too fast, because they think that rates are going to come down very quickly. That can be not the best trade, and it's been really volatile for investors time and time again in the last 4 years. Or just piling back into equity. Equity risk seems to be a huge appetite for the U.S. investor, and not offsetting that risk. Once you get through some comfort level, there's a dip or there's a market volatility, we see investors just go all the way back in. So not being more balanced there and diversifying your risk is what I actually think is the risk, not necessarily an event.